Most new traders enter the market trying to strike it big on a single entry. They find a stock they like, put all their capital on the line at once, and sit back to watch. If they guess wrong, they take a massive hit right out of the gate. This chart shows a much safer approach, adding to a winning position over time. Notice the progression. You start with an initial buy at the bottom left and follow it with a second buy, and then a third buy higher up the trend. The profit multiplies with each addition, but your risk stays completely controlled. We can break this mechanical process down into 3 clear phases: planting the seed, watering the plant as it grows, and building a fence to protect your harvest. In the following scenes, we will demonstrate how layering these entries allows a trader to build a high-conviction position without ever exposing their full account to an unconfirmed trend. Step 1 is planting the seed. Instead of committing your entire account balance to a new trade, you start small. This initial position is simply a test to see if the market has actual momentum in your direction. Look at this chart mapping out a multi-entry trade. We start at the bottom left with long 1, placed right at a clear support level. Immediately, we set a strict boundary, stop loss 1, just below that entry point. Because this first position is small, the exact dollar amount at risk is low. If the trade fails immediately and hits that stop loss, the impact on your total capital is incredibly minor. You take the small paper cut and move on. This first entry serves as a tactical probe. By entering here, you secure a foothold in the trend, while keeping the potential dollar loss at a level you can easily ignore. Once the trend establishes itself, it's time to water the plant. This chart shows adding shares during pullbacks. Notice long 2 and long 3 right after the price dips to the moving average. Sometimes there is no pullback. At long 4, the trader adds on pure momentum as the price breaks upward. Regardless of exactly when you add, you have to follow the pyramid strategy. Your initial entry forms the wide base of the structure. Every subsequent position you add must be equal to or smaller than the previous one, never larger. Notice that we are only adding when the overall trade is in profit. You never add to a losing position. Buying more shares as a stock falls, averaging down, rapidly accelerates your risk and can entirely ruin an account. Watering the plant means you reserve your heavier capital allocations for the moments when the market has thoroughly proven your initial entry was correct. Now that you have a larger position generating profit, you have to build a fence to protect it. As you add new shares, you must raise your stop loss to lock in those accumulating gains. Looking back at our multi-entry chart, track the bottom red lines. As the position grows from long 1 to long 2, the trader trails the risk boundary up from stop loss 1 to stop loss 2, and eventually stop loss 3. Adding shares at different prices creates a single weighted average cost. Once you trail your stop loss above that combined average, the trade effectively pays for itself, entering a risk-free state where your initial capital is no longer on the line. But there is a mechanical trap here, choking the trade. Moving your stop loss too tightly behind the price means normal market volatility will knock you out before the trend finishes. This sequence illustrates the problem using a short trade. Panel 3 shows the stop line move directly to the entry level. Panel 4 shows a minor pullback hitting that stop, taking the trader out right before the price drops heavily in their intended direction. The trader was correct about the overall trend, but poor stop management forced them out. You have to place stops strategically below structural support levels, giving the trade room to breathe instead of just rushing them upward. To sum up the system, start small to test the waters, only add size to positions that are actively winning, and aggressively protect your accumulating profits with trailing stops. To put this into practice, open a chart of an asset you follow and locate a strong historical trend. Map out exactly where you would plant your initial seed, where you would add size on the pullbacks, and how you would trail your stops along the way. Following these steps replaces hope with a repeatable process. You stop guessing where the absolute top is, and you let the market pay you to hold the correct position. By mastering the mechanics of scaling, you graduate from an emotional participant to a mechanical trader holding a structural advantage over the market.